central bank easing, and the potential cooling in the China-U.S. trade war. These have set the scene for a global economic rebound in 2020, and our forecast pushes the risk of recession into late 2021. Welcome to our 2020 Global Market Outlook. I'm Russell Investments Quantitative Investment Strategist, Dr. Herein. And today I'm joined by my fellow quantitative investment strategist, Abraham Robeson. Abe, we're looking ahead to 2020. What do we see?
Kara, hold the epitaphs. This aging economic cycle seems to be likely to last beyond 2020. Aside from central bank easing and potential de-escalation in trade war, tentative green shoots in global manufacturing suggest that we might be on the cusp of another mini-cycle recovery through the first half of 2020. While a deal is not certain, we believe that both China and the U.S. have incentives to reach a Phase 1 deal on trade war soon. President Trump would like to declare victory in the trade war ahead of this 2020 re-election bid. Xi Jinping, Chinese president, on the other hand, would like to limit the risk of a further trade shock. He's striving a balance between short-term requirements of economic stimulus and a mid-term need to reduce the debt levels in the Chinese economy.
Now let's look at markets region by region. In the U.S., low inflation should keep the U.S. Federal Reserve, the Fed, on hold during 2020. Of course, the November presidential election is likely to be a major source of uncertainty. Low unemployment and trend economic growth favor Trump's re-election. The Democratic frontrunners all lean towards at least a partial repeal of the 2017 corporate tax cuts, which would have negative implications for corporate earnings growth in 2021. In the Eurozone, we believe the region should see a gradual pickup in growth due to easier monetary conditions, the recovery in global manufacturing, the potential lifting of trade war uncertainty, and Chinese policy stimulus. The absence of inflation pressure means the European Central Bank is unlikely to consider lifting interest rates. The ending of Brexit uncertainty and increased fiscal stimulus should support the UK economy in 2020. Both major parties in the December 12th general election are proposing pathways to Brexit resolution and the end of fiscal austerity. A significant boost from fiscal policy is likely, regardless of the election outcome. We believe that Chinese stimulus will likely be modest, enough to stabilize or provide a small boost to the Chinese economy. Japan should also benefit from the stimulus, as it will help bolster export demand. In Australia, potential income tax cuts could provide a boost, but a sluggish economy will likely have the Reserve Bank of Australia considering another interest rate cut. We expect further rate cuts from the Reserve Bank of New Zealand. The Bank of Canada has been an outlier when it comes to central bank easing. It has the highest policy rate in the G7 and has resisted cutting rates despite softening global and domestic economic conditions. The hesitation is in part due to fears of stoking household debt. Lackluster consumer and investment trends should eventually force the BOC to consider rate cuts.
If we look at economic indicators, we see an unemployment rate of just 3.6% in the U.S. in late 2019, which is causing wage pressures to build. We expect U.S. non-farm payroll growth to remain above 100,000 jobs per month in 2020, dropping unemployment rates to levels not seen since the Korean War in early 1950s. Keeping the Fed on hold and an improving U.S. economy should lead to higher Treasury yields and a steeper yield curve. The 10-year Treasury yield could rise to around 2.25%. Italian 10-year government bond yields under 1.2% in late 2019, mirroring the declines across Southern Europe and supporting stronger financial conditions across the region, while China is likely to increase local government bond issuance to boost infrastructure spending. We might believe that gross domestic product should remain around 6%.
Now let's talk asset classes. We have a small underweight preference for U.S. equities, driven mostly by expensive valuation, but also because cycle conditions appear firmer outside of the U.S. We favor non-U.S. developed equities. UK equities offer good value, as demonstrated by the 5% dividend yield. In Japan and Europe, valuation is neutral. We think both markets will benefit from fading trade war concerns. We also like the value offered by emerging market equities.
For fixed income, high-yield credit is slightly expensive and at risk from slowing corporate profit growth. Investment-grade credit is expensive, with a slightly below-average spread to government bonds and a decline in the average rating quality. Government bonds are also likely universally expensive. We think the U.S. Treasuries offer the most attractive relative value. The Japanese yen remains our preferred currency. It's still undervalued, despite this year's rally, and it has safe haven appeal if the trade war escalates. we could see the US dollar weaken given its counter-cyclical tendency. The British sterling is very undervalued and has an upside on most scenarios following the UK's December 12 election.
Abe, 2020 is just around the corner. And while we're pushing the risk of recession out to late 2021, there's still a lot to pay attention to in the coming year, including that rebound mini-cycle. Throughout the year, we'll keep a close eye on what's coming, and we'll strive to keep you informed.
See you next time.
Hi, I'm Sophie Antel-Gibert, Consulting Director for Russell Investments. If you liked this video and would like to see more like it, please subscribe to our YouTube channel.